So just to let you know that I will not be giving personalized tax information. And we're going to talk pretty general as we go through things.
Sounds good.
All right. So who I am, basically, I've had 35 years of doing this. I had a mortgage broker's license for a number of years. I taught accounting. I've been teaching and coaching entrepreneurs, starting businesses, new tax preparers, and I've been able to create a lifestyle that I enjoy. And we're going to talk a little bit about how um, to become a tax preparer, whether you work for someone else or you work for yourself. Um, it's a great lifestyle. So I have to say, I do enjoy it. Okay, so each week we're going to go over and have some goals and do some stuff, but tonight we'll move somewhat slower. But over the next couple weeks, we're going to move faster. Tonight we're just going to basically walk through what a 1040 is. All the things we're going to discuss tonight is we're going to go over in more detail throughout the next couple of weeks because there's a lot of things on this 1040 that and the more you know about taxes, the more you don't know. But so this here publication 17 is free. I did email it to you, but you can also download it for free at irs.gov. But it's called Publication 17. It's fairly big. It's not something you want to print out, but it is something that will guide you, and we're going to use that in teaching this class. That's kind of going to be our workbook. The reason you should be taking this course is um, strategically, you're going to help yourself financially, and you can help your financially your tax situation for your family. Taxes can be burdensome to some families. So one of the things that we do is, which I find interesting, is in tax consulting, is finding ways that are legal and how to save people money. And I always feel like I'm doing a service. Like we're keeping everybody in compliance. We're not doing anything illegal, but how can we save people money? Um, Another one of the things that we want to do is through this course, you want to be credentialed, you want to be street legal, you want to be a tax professional. So you can provide tax services to people who pay you for them to become a tax professional. Um, and another reason for taking this course is both one and two. Jesse said it, he wants to learn for himself and to be self-employed. Um, So those are great reasons for this course. The course will help you and guide you to those things. We have a more in-depth course that does go into self-employment and self-employment taxes. We're going to briefly talk about it in this course, just because that is a little in depth. So this is when you complete your basic tax training, you can become a tax professional. And one of the things you want to do is you want to try to get at least, your first handful of clients if you want to become a tax professional, or you want to help. And sometimes in the beginning, you want to do it for free just to get the experience. Or you want to mentor with someone who's experienced, or you start out as just data entry as in an office. Um, and as you get experience, you can raise your prices on existing clients. At certain points, you want to do that. So part of it is, you can make decent money. You make money in primarily 3 months. And a lot of times you have to learn how to budget. So you can make a decent amount of money in 3 months, what some people make in a whole year. You're making in 3 months. And if you spend it right away, you have no money in October. And a lot of people have um, added different services. While I was a mortgage broker, I added that during my slow time so I could earn money year round as my practice built, I don't have to do that anymore. Um, I'm earning enough money and I've learned a budget over the years that when April 15th comes, I put a chunk of money in the bank so that come October, November, I still have money to pay my bills. And there's, as you grow, you can become a team leader if you work for a firm, if you work in one of the large box stores, H&R Block, Jackson Hewitt. If you work in those stores, they usually want you to take their courses. You can leave a legacy to other people, your family members. But the main thing I think for most people is we want to make sure we live a lifestyle that we want today. Um, and you want to save up for your retirement so that in retirement you live a decent lifestyle. And I've been doing it 38 years and been self-employed, so I've found it a great lifestyle and it gives me a lot of freedom. I just got back from the Caribbean for a week and I could take a week off and still the office operated. Carolyn was in and worked. And as you grow and I'm getting to the point where I'm doing more mentoring and overseeing and not as much doing business returns, but not as much as the individual returns. That's what we're going to learn here in the next couple of weeks is how to do an individual return. So you can come in at different levels for your career path. You can come in as an entry level as you're doing data entry. You might be a preparer where someone's reviewing every one of your returns. You're going to get a basic understanding of 1040, and you're going to have all of that at the end of this class. When we're done here, you will be ready to be an entry level tax preparer or an assistant. It takes a lot sometimes. You can get your repeated. A lot of times people say, what do you need to become a tax preparer? And basically, you don't even need a high school diploma. You need some experience, you need some classwork. The IRS requires you have what's called a PTIN, and we're going to talk about how to get one of those, and everybody's going to get one. And you can become an AFSP, which that's what I am. I have a degree, a master's in tax, but I never sat for the CPA exam, and I technically don't even need the education I have, but I do have those degrees. Um, the AFSP is a designation that the IRS gives you. Many years ago, they wanted all tax preparers to take an exam, and you had to pass it. And I took it the first time, I passed it, but a lot of the H&R Block preparers, the large box store preparers, protested. So the IRS came back and said, okay, you don't have, they can't force you to take this exam, but if you don't have certain, you can become an enrolled agent. You can do all kinds of stuff without a college degree, even. But the IRS came back and said, if you have this designation AFSP, every year you need to take this exam and complete 15 hours of continuing education. Those of us who passed it the first time were grandfathered in that we don't have to take the exam every year, but we do have to complete 15 hours of continuing education. There has to be hours, I think it's 3 hours in all the new tax data, and every year, the good news about this job is every year the tax laws change. So we're employed. Every time there's a new president, no matter what side of the fence you're on, you're going to be employed. They're going to change some tax law. They run on tax, like, oh, we're going to save you this kind of tax or that tax. Right now, currently in Congress, there's some tax laws that could be coming out this month. So there's always changes, and this really guarantees us our job. As much as people are nervous about AI taking over, they're nervous about TurboTax. When TurboTax came out, people were losing. But all of those things don't know tax law and don't know how to apply it. And when TurboTax came out, my business doubled because people prepared their own returns and screwed them up. So they had to come to us to get them fixed. And that's one of the things that, we try to do is make sure that when we sign a return, the return is complete and it's not gonna have a lot of issues with the IRS. So you can take the AFSP, it's a 1-day course, you take an exam, it's a basic, and everything you need to pass that exam, you're gonna get in this course. I'm currently pending IRS credentials for teaching. They should hopefully will come through before the end of this class. But because the IRS was on furlough, I spoke with them in October, and they were supposed to give me my credentials for this class. It didn't come through because of the furlough. But everything you do get in here will prepare you to take the exam. And then once you take the exam, you have a year to get your CEUs. But you don't need it. You do not need to have the AFSP behind your name, which is the annual filing seasonal preparer, is what I think it is. Don't quote me on that. But so the next part is an intermediate experienced tax preparer, an office manager, someone you've been doing tax returns for a while. You have some experience. You might even be reviewing tax returns. You definitely want to be able to do some tax planning, look at Schedule Cs for sole proprietors. If you're in a farming community, Schedule E is for people who have rental properties. So that's once you get into an intermediate area, and that's after a few years. And then you advance as an enrolled agent. An enrolled agent is another exam you take with the IRS. It's 3 parts. And again, they have the same continuing education. And, eventually you can become an expert strategic tax strategist. So I think that's kind of where have been for the last about 10 years, is I really like the tax strategy and how I can save someone who's self-employed money by becoming an SRC corporation. So I like all of those tax strategies. And basically, you guys are at the level of tax preparer and assistant, the entry level. And by the end of this class, again, you're going to know how to file a basic return and what does it mean. So those are all important things. So we're going to walk through a 1040. So in your handouts, I gave you a 1040. This is the PDF of a 1040. The top part of this 1040, this is it, and we're going to talk all about 2024 taxes because we don't know if 2025 taxes are done yet, prepared yet. So the first top part of our 1040, if someone has a short year, for some reason they moved in the country in June and they only started working in June, we would put that in here. But most people work the full year. You want to always check their social security card. You want to see their name, last name, social security number. If they're married, we need their spouse's name, spouse's social security number, their home address. IRS does not like PO boxes. So we want to, city, state. The presidential election is, you can donate $3 to this fund. It's a fund for the next presidential election. If someone is out of the country, they would use these foreign codes. So again, the tip here is you want to ensure that the names match what's on your social security card. And you also want to do that for dependents. A lot of times we'll see dependents. The tax return, we electronically file most returns and they'll get rejected because for some reason the last name of the dependent's not spelled correctly, or if they have a hyphenated. So you want to always make sure that your social security cards, or they have a TIN a taxpayer identification number for someone who is here on a visa or something like that, they still would have to pay. So your filing status is you can be married, single, you can be married and file separately, married filing jointly, head of household, which is usually a single parent or a person with, sorry, it's usually a single parent, or if you are an adult and you're taking care of one of your senior parents, you can also qualify as head of household. And a qualifying widow is if your spouse passed away in the current tax year. Dependents, again, you can have a parent be your dependent, but usually it's your child, a foster child. And when you look at the 1040, again, you're going to put in the relationship, their social security number, the relationship, and do they qualify for the child tax credit? And then the credits for other dependent. So another dependent is if you have someone living with you and they can be of any age, but they have income under, I think it's $1,500, a low income, you can claim them as a dependent and get a $500 credit for that. So you always want to make sure that if you do have someone staying in your home, and you're supporting them, you can claim them as a dependent. And again, your parents, you can claim your parents. Everyone needs, your dependents need to live in your home except for your elderly parent. And you have to support them. And we're going to go into real detail about this next week. But you have to support your parent more than 51%. So if you have a parent that's just getting Social Security income and the children, are paying their rent, their mortgages, their food, the children can claim them as a dependent. Not only is for your parent, but most of your dependents are children, and they have to live in your home. And they have to live in your home for 12 months. So this is, again, here's where we're putting dependents. Their social security, the first name, last name, social security number, relationship to you, child, son, daughter, mother, father, uncle, aunt, other friend. And then if they qualify for the child tax credit, and we'll get into who qualifies for that or not. The other thing is, but we always have to answer these questions on the 1040. Digital assets. At any time in 2024, did you buy or sell or exchange a digital asset? And that's, crypto. You want, the IRS is now asking, have you done that? And if you have, you have to, if you disposed of it or you sold it, we have to report that. That's income. And then can someone else claim you? Oftentimes you'll have working children whose parents still claim them, but the kids have a job at McDonald's or something. So they're a dependent of someone else. So, or your spouse, your spouse could be a dependent. Young people get married, they're in their 20s, they're both in college, their parents can still claim them as dependents. And then if you were born before January 2nd, 1960, are you blind? So there's an extra credit if you're blind, and if you're older, you get an extra credit as well if you're a senior. So these are your basic, this is our basic 1040. So there's tests, and we're going to go through all the tests that you have to meet to claim a dependent, to claim a residency support relationship test. Next, we're going to come to income. And that's line 1 of that 1040. Is your income from wages, salaries, W-2s. You get a W-2 from your employer. That's going to go in line 1. if you receive, and again, I'm gonna flip back here to the 1040 just to point some things out. To you. Here on the 1040, you can see if you're a household employee and wages are not reported on a W-2. So if you work as a nanny, you're a housekeeper in somebody's home, it's a household. So this is if you work in someone's home. Tip income. Now this is going to change in 2025. There's tip income is now the first $10,000 is what it's supposedly being is not going to be taxable. So this is going to change. And again, we're going to see this dependent care benefits. If you if you received dependent care benefits from your employer, but you didn't spend them on dependent care on your children. So some employers, some of their benefits is, hey, you can defer up to $5,000 for childcare. But if you don't use it for childcare, then you have to claim that as income. So an adoption, so these are all kinds of income that you can have. And that's all in line one, the different one, A, B, C, D, E, F, G, H. Non-taxable combat pay election. So if you are in the military, you're in combat, that income is not taxable. Then we get into 2A is our interest. So interest on your bank account, if you have money and dividends, you get interest on money. The bank credit union gives you interest. Dividends, sometimes a credit union will give you dividends, which is technically interest for tax purposes. You can invest in certain kinds of bonds that are tax-free interest. So the tax-free, tax exempt interest, you're going to report here on line 2A. Taxable interest, and these are going to be reported on a 1099 INT. And I'm going to show you those in the second half of the class today. But and then on a 1099 from your investment, you will get dividends. If you Charles Schwab, Solomon Larney, E-Trade, and you have investment, you own stock, you're going to get dividends. Those are reported here on line 3A and 3B. There is qualified dividends, and then there's ordinary dividends. And the documents tell you what it is. Like, you don't have to figure it out. If someone is receiving an IRA distribution, usually seniors, people over 67, may be receiving income from an individual retirement account or an IRA. There will be two parts of this. There'll be the total distribution, and depending if they deferred it or not, there'll be a portion of it that's taxable and a portion that's not taxable. And again, each document will tell you, hey, this is taxable, this is not. Pensions and annuities, same thing. If you work for Philadelphia, you can receive a pension. Social Security benefits, and there's a whole worksheet for Social Security, but only half of your Social Security can be taxable because you can take Social Security and still work. So if you're still working and you're older and you're taking Social Security, part of that could be taxable. But if your only income is Social Security, 90% of the time it's not taxable. And you're only taxed, it's prorated. So when people say, oh, my Social Security is taxed, well, that means that they're making more money either in investments or they're still working. They're still having other income coming in. They may have retirement funds. So they're making a decent amount of money to have their Social Security taxed. We're not seeing a lot of lump sum elections anymore. But capital gains is if you own stocks or bonds and then you sell them and you sell them for more than they were worth, you have a gain. If you lose So if you went and buy IBM stock, the stock market, and you bought it for $20,000, but the stock market went down and now it's only worth 15,000 and you lost $5,000, you can deduct the loss here up to $3,000. But then that other 2,000, we're going to carry it over to next year. So you don't lose it. The IRS says you can only deduct 3,000. But if you had that $5,000 loss and you bought and sold other stocks that had a gain of 15,000, you can deduct that 5,000 total, and you only have to claim 10,000 in capital gains. Does that make sense?
So are you essentially tracking your own debt like that you have in the market kind of? Or
Right.
like,
Well,
yeah,
at the end of the year, if you're in any trade or uh, and you bought IBM stock and you sold IBM stock, they'll tell you at the end of the year how much gain and loss you have.
I see.
Yeah,
Okay.
so they're pretty good about that. And then we just have to report it here. And you say, hey,
Gotcha.
I had a profit or I had a loss. But if you have a loss over $3,000, you still will report it. It gets reported on another form, and then that'll carry over to next year. So you have to remember that next year. Now, when we're doing tax returns in the office here,
Yeah.
we have software. So our software, I've had clients actually for over 30 some years. I have their children now, my clients. But so the software tracks all that for me.
Gotcha.
I don't have
Okay.
to, yeah, I don't have to remember. But if you're preparing your own tax returns or you're doing stuff on your own by hand, you'd have to track that.
Okay. Thank you.
Yeah, so that's stuff you'd have to track. So down here is any additional income. If you receive that $7, if you do jury duty, you have to report that. If you work at the polls, um, if you receive, let's say you just you made some kind of widget and you sold it for $300, you would report that here. The IRS says any income you receive, you would have to report. So if you sold your old car, is it reportable? Well, depending on what you paid for it, so a lot of times um, we don't need to report it. But if you do any kind, if you subcontract, somebody may give you a 1099 for $500, you will report that here. You don't have a business. So anytime you get income is income. So So now we have what are called the adjustments to income. So these are above the line. They reduce your adjusted gross income. So common adjustment, educator expenses. So if you are an educator in a classroom between kindergarten and 12th grade, you get what's called an educator credit. And that supposedly is going up for 2025. It's $300 if you're a teacher in again kindergarten through 12th. If you're married filing jointly and you're both educators, you can take up to $600. IRA contributions. If you're not in a if you're in a retirement plan with your employer, you can contribute to a Roth IRA with income limitation. But if you're not in a retirement plan, you can contribute to your own individual retirement plan. What this does, it's going to lower your taxable income. So these are deductions. If you're self-employed, your health insurance lowers your taxable income. Student loan interest. If you're paying student loans, that lowers your taxable income. These are all on Schedule 1 of your 1040. HSA. So they will be subtracted from your income as when we look at the tax return. I'm gonna see if I can switch back here quickly. When we get back to the tax return, you'll see here on line 11, this is your adjustment. So we're going to take all of those off. We're going to subtract them, and then we get our AGI. And you'll often hear people talk about what's your AGI? That's your adjusted gross income. That's your income after your adjustments. Exactly what it says, adjusted gross income is income after adjustments. And then usually the only other thing we get to deduct from this is our standard deduction, or you can itemize. And a qualified, if you have a business, a qualified business deduction. So your standard deduction, and again, this is for 2025. If you're single, you can deduct $15,750. Married, filing jointly, $31,500. Head of household is $23,625. If you're married, filing separately, you have to split that, or if one of you itemizes, the other has to itemize. Married filing separately, 90% of the time is the worst filing status. So you want to make sure if you're filing, and the reasons people file separately is there could be your spouse could owe some money. If your spouse is involved in any illegal activity, you don't want to file jointly. Because when you file a joint return and you sign it, you are both liable for that tax liability. So even if, I pay all my taxes and my spouse, my wife, does not pay her taxes, and we file a joint return, I'm still liable for her taxes. So in those situations, sometimes people will want to file separate. It is the worst tax situation to be in. So you either want to file married filing jointly if you're joint married or separate. So your standard deductions, you can either take one or the other. You can either itemize or you can take a standard deduction. You can't take both. So if you're married, filing jointly, let's say a married couple, they can take $31,500 as it just so your first $31,500 is not taxed. It's a deduction. It reduces your income. So, or you can itemize. You would take your mortgage interest, taxes paid, medical expenses, charitable, and if that adds up to more than 31,500, you would take that, you would itemize versus taking a standard deduction. About 3 or 4 years ago, they changed the standard deductions to make them much larger because they really don't want people to itemize, proving that some of your charitable, that you're no longer allowed if you're a W-2 employee to take work expenses. So they eliminated a lot of expenses. And we'll go through all of these in much more detail. Today, again, we're just doing a review. But in your itemized, if you take medical, it's subject to 7.5% of your adjusted gross income. So you would take that adjusted gross income number we talked about, multiply it by 7.5%, and you only get the amount above that as a deduction. So again, we go back to our 1040, and you can see here we're going to either write our standard deduction or our itemized, and we would fill out the itemized. It gets filled out on a Schedule A. And we'll again talk about that. So you can deduct a qualified business income deduction. And that's if you have a business, you can deduct a qualified business deduction. So when we go to the next page of our 1040, if you're filling these out by hand, you would always hear on the top of the page, put the taxpayer's name and their social security number. If you have multiple pages, every page has to have their social security number, at least their social security numbers. So we're going to figure out tax. And the tax comes from either the tax tables or percentages of you can, and oftentimes we're going to use tax software. They can go by capital gain tax, they can go by the tax tables or the software which you take your taxable income. If you look at your Pub 17, there will be plenty of places that show there's a whole tax table in there, and you find your income and filing status, and that's what your tax would be. So when we go here to the Google and we go to irs.gov, you can get any documents, and I gave you a list of documents that you should get and you should take a look at. This Pub 17, so it's publication. You can download any information you need. So you can actually read it in multiple languages as well. Here it's written in Korean, Russian. So Pub 17, you can get a print version with ebook, but this is the Pub 17. And this is really our handbook that we use. And on all of these pages, and then page 112, these are our tax tables that we were just talking about. So if you have somebody earning $25,000 and let's say they're married filing jointly, so you would go down to the $25,000. There's 25,000 to 25,050, and single, married filing jointly, married filing separate, or head of household. And you'll see, as someone who is single, their tax would be 2771. Married filing jointly, the tax would be 2539, and married filing separately 2771. And then head of household 2672. So again, the tax on a married filing separate is going to be higher than married filing jointly. So if you had, if you were married filing jointly and you have two people earning 25,000 total, they're only paying in $2,539 because you're having two people living on 25,000. When you have a single person living on 25,000, you're going to pay more taxes. Eventually that reverses, where a single person, as the income gets higher, a single person earning a higher income, which is a married couple, it can sometimes reverse and you get hit with a married penalty. So you always want to watch that, and then this is where you want to watch, when does my tax rate go up? But this is a tax chart, so you can go in here and look at somebody's tax, what their adjusted gross income is, and then you can find on the chart the tax, what their taxable income would be, how much tax they would owe.
So does adjusted gross income always land in an increment of 50? So like in the 3,500 column, or I'm sorry, 3,500,000, it'll be like 35,000, 3,550, and then so on and so forth, 100, 150, 200.
No.
Oh no, okay.
So you can make $34,024.
Okay, yeah.
So that would be in between the 34,000 and the 34,050. So that
Okay.
would be your tax. So you
Oh, okay.
from 34,000 up to 34,050, and that's what you would pay.
I see. That makes sense.
Yeah.
Thank
Yeah, so it never equals out because when you're working at your jobs, everybody, and we round everything up or down. So if you're working and you made $25,572.29, it would just be the $2,572. If it was 51 cents, you round up.
Okay.
So
Gotcha.
yeah. So we don't use cents in tax prep. Very seldom. There's some counties, I think it's Montgomery County, that will ask you for the cents. But
Wow.
most of the time, Philadelphia, Pennsylvania and the federal do not ask for cents. They ask you to round it.
Okay.
So, so line 16, we're going to get our tax tables. We're going to use the tax tables or software. And then line 17 through 20, back on our 1040. So line 17 through 20 are additional taxes. So there's additional taxes. There can be a farm tax. You can have tax on certain investments. All right, before I get on to that, Myra has a question here. So let's go back to the tax table and answer Myra's question. So if you have a married couple, husband makes 72,000 and the wife makes 23,000. So you would add the 72 and the 23, which would give you $95,000. 4 kids and one person you take care of. So one, say a parent. So at $75,000, you go down to the tax table. So you would take the total income of the husband and wife married filing jointly of $95,000. So we come all the way down here to 95,000. So they make 95,000. They're still married filing jointly. Okay, the tax would be $11,012. Do you see that? Okay, so they would. Okay, then, and we'll go into other credits. So we go back to the 1040 on Myers case here. So we would put the tax here, and then if we have any amounts from Schedule 2, and again, if you say, well, what's Schedule 2? Well, we would then go back to the IRS website, and we would, we would go back, or you can go back to your Pub 17. And this is why I'm just going to show you how to find your answers. The big thing of taxes is not always knowing everything, but knowing where to find your answer. So when we go back to the Pub 17, if we go back to our index here, we can, and it talks about everything we've just gone through here, the standard deductions, and then when we talk about taxes, is so here is they're going to add more taxes in, or taxes you can deduct. So here you can figure your state, local. So they have all these other worksheets. These are taxes you can deduct. These are deductions, itemized. And then after you get through, again, we're going through the same way. You're going to figure out credits. So we're going to figure, there's ultimate minimum tax. If you have an income over a certain amount, you're going to have on this Schedule 2 additional taxes. The other thing that you can do is when you go to the IRS.gov, you can then type in here Schedule 2. And then Schedule 2 will come up. And these are your additional taxes. So one of the additional taxes is if you've got your health insurance on the marketplace, but you understated your income, now you owe money at the end of the year. So these are repayment if you claim some vehicles. So these are all different taxes you can pay. You can also pay self-employment tax. If you didn't pay on your tip income, you'd have to pay that. Uncollected Social Security, Medicare taxes. If your employer didn't withhold enough, you'll have those. All these taxes can be added in to your taxes. So, if you took too much out of your HSA, but you didn't use it for medical, you'd have to pay tax on that. If you have an early withdrawal on your IRA, you have a 10% penalty tax. So all of that stuff gets added in here on this Schedule 2, and then it would be reported on your 1040. So, but when we go back here to our 1040, we're going to add up. You're also going to have child tax. So in Myra's case, she has 4 children. You get $2,000 per child. So you get, but let me just step back here in Myra's case. When you have $95,000 as income, then you have to deduct your standard deduction from that. Then you have to get your tax amount. So you wouldn't be taxed on the total 95,000. You would deduct the standard deduction. Do you remember what the standard deduction for married filing jointly was? Was 31,500. So you would deduct the 95,000, and then you would take out the 31,500. So taxable income would only be 63,500. Your taxable income is 63,000. So we were incorrect in figuring out. But then once you figure out the tax, and then we go back to the tax table in your Pub 17. Trying to figure out where I have my Pub 17. So in your Pub 17, when we go back to the tax table for so the taxable income is 63,500. I'm going to share this with you. I'm going to share my screen so you know where I'm getting these numbers from. Okay, so here we're going to go to 63,000. $500. The taxable income on that is only $7,159. Okay. You come back to your 1040. Share that again. So when we come back to our 1040, the tax is going to go up here. We're going to put in on line 16, $7,159. And then we're going to get child tax credits. And I'm going to see it. So for 2025, the child tax credit is $2,200. Now, if we had, 2024 was $2,000. So if we had 2,000 for 4 children, which is $8,000, we now have no taxable income. So a couple married filing jointly with 4 children would have no taxable income.
I might need to hear it one more time, truth be told.
Sure. So the couple earned $95,000 together.
Yeah.
They had a standard deduction of 31,500.
Okay.
Brings their taxable income to 63,550.
Yep.
We looked up the tax on the tax table, and the tax was $7,159. Now,
What was 7,000 again?
that's the tax.
Okay.
So their taxable income is 63,000 after their standard deduction.
Gotcha. Okay.
So they make 95, you take off the 31,500, comes down to 63,500.
Gotcha.
Then you have your tax. So we go over here. We're going to go, I'm going to share this here. We go to our tax table and we find a 63,500, which is right here. Married filing jointly, they pay $7,159. See where I'm getting at?
Yeah. So for filing, you're basically knocking off, what was it, 30K from the combined couple salary or the married couple salary?
Correct.
Okay.
Single, you're knocking off 15,750, half of that.
Okay.
Yeah. So,
Okay.
and then from that, that's called your taxable income.
Yeah.
Okay, so your AGI is the 95,000, the taxable income is 63,000.
Okay.
After you deduct your standard deduction. Then we find our tax liability of $7,159. Now, Myra says in her example, married couple filing jointly, they have 4 children, and they take care of. She says, what other person they take care of? I'm going to say they take care of their mother. Lives in a house. So now we have. So their total tax again is the 7,159. They're making 63,500 right here. So when we go back to our 1040, okay, we're going to put that tax in here on line 16, 7,159. Are you good with that?
Yeah.
Okay. So they have no self-employment, they have no other extra taxes, but they have 4 children. Now, for each child, they get a $2,000 credit. So for 4 children is $8,000. That gets deducted from a credit gets deducted from the tax.
I see.
So they owe $7,159, but they have an $8,000 credit. So they have
Right.
no tax liability.
I see. Okay.
So their total tax down here, you're adding, self-employment tax, like, so you're adding in other taxes, but they have no other taxes. They only have the child tax credit. They also get, if it's their parent that they're taking care of, let's say, they would get $500 for that other dependent. So actually, they would get an $8,500 deduction, but the taxes was only 7,159. So their total tax here on line 24 is zero.
Is there anything that carries over into the next season? So
Not
because
not for this stuff. This is
okay,
what's called non-refundable credits. There are
gotcha.
some credits that are refundable, adoption credits, and we'll get into what those are in more detail. But
Wow.
for our purposes,
Interesting.
these are non-refundable credits.
Okay. Thank
But
you.
it just zeroes out their tax liability. They owe no taxes. So married filing jointly couple with making 95,000 with 4 children are going to pay zero tax dollars. And if you look, I'm just gonna go here to what I'm gonna share this W-2 with you. So this W-2 here is a sample where somebody made $14,205. But this is their income. The tax withheld, federal tax, box 2, is $1,250. So this is where we're getting these numbers, their wages. So this $1,250, we go back to our 1040. So we go back to the 1040. And you can see we're going to have the federal tax withheld on the W-2. We'll go here. So it was $1,250 was withheld, we'll just say, on this. But they owe zero tax dollars, so we're going to deduct that. And so they're going to get a refund of, they're going to get all their money back. That was withheld. But you also get other credits here. You get it if you can get an earned income credit. So if you're head of household, or you're married jointly, or you're single and your income's low, you can get an earned income credit. And that is what's called a refundable credit. So, and you kind of look at this with payments. These things act like payments, earned income credit. The American Opportunity Credit, that's for education, first 4 years of college, especially if you have children and your children are in college, for the parents, they can get this credit that's refundable for the first 4 years of college. It's credited to the parent, or if you're an adult and you're working and you're in your first 4 years, if you don't have a bachelor's degree, you can get an American Opportunity Credit. If you have a bachelor's degree, if you have a 4 year degree, you can stay in school forever and get what's called lifelong learning, as long as it's an accredited university. So we add up all these payments. This is our tax due. On our case was zero, but whatever our tax due would be subtracted, and they would either get a refund or they would owe money. You're going to list everything that you paid into the IRS, and that includes the federal income tax withheld on your W-2, or if you get retirement income, they'll withhold taxes. If you don't have W-2 income, you're self-employed, or you have large investment income, you would have to pay estimated taxes. And then you would record those, and then you'd have your refundable credits, your earned income tax credit, and your CTC and educational credits. So this is pretty much how, we compute taxable income, gross income, and these are kind of just a review. This is a really good slide, just kind of as a review. And I send you the copy of the slides. This is one that's really good. It's probably out of place in your PDF. But you're going to do your AGI minus deductions. You're going to get your gross income minus your adjustments. You get your adjusted gross income that we talked about. Then your adjusted gross income minus your deductions gives us our taxable income. And that's where we took the 31,500. That was our deductions, our standard deduction, and then we got taxable income. And then we're going to calculate how much tax we owe. And you take your credits and withholding and determine if you're going to get a refund or do you owe money. So if you're a tax preparer, you have to keep tax returns for every client, every return you do for 3 years. They've now 7 years if you're reporting losses or depreciation. And this is our job as tax preparers, to keep these documents. If there's a loss, depreciation, you have a rental property, you have business, you may have some of these things, you're required to keep them for 7. They have adjusted that we can keep them electronically. And there's certain legislations and ethics about how you have to keep tax documents. You can't email a tax document. You have to have a secured server, and it has to be secured. You have to have a plan of how you secure your documents. So all of this stuff is all legislated by the IRS to say, hey, if you're a tax preparer, because if the identity of one of your tax clients gets stolen, you could be liable if you did not abide by all these safety measures. So let's say I even emailed my own personal tax documents to my wife, and one of my clients' tax documents, they got leaked. Something they had they can charge me because I emailed a tax document. So you cannot email any tax documents ever as a tax preparer. And I get I forget what we were doing. We are doing something, and we needed, and it was, I think it was a bank or something for, they needed our updated income, and they wanted me to email our tax returns, and I was like, I can't email you my tax returns. They're like, oh, it's secured, and they didn't get that. It's like it's illegal for me to email you my tax return. Um, so no matter what anybody says, you can't email a tax document. So you're going to compare the total tax, total payments. You get a refund or you owe money. If we encourage everyone, and the IRS is now coming out where you have to file paperwork if your client doesn't want to e-file. And we have very few people who don't want to e-file. But in Pennsylvania, if you're dealing with any Amish, they do not electronically file anything. You have to paper file. The IRS requires us, if you file more than, I think it's now 35 returns, you have to electronically file. So we have to electronically file returns for our clients. If you have a client that doesn't want to electronically file, they have to sign off. Everything in the IRS has a form. So of course I don't remember every form number, but I know that there's a form for it. And again, I'm going to go back to my Pub 17, or I'm going to Google search and say, oh, what form do I need? They're now coming out with that everyone, they don't want to issue checks. It's a big thing. Like IRS checks usually will arrive on a Saturday when people are home. But they're now don't want to issue checks. They want everybody to have a direct deposit. One of the things with a direct deposit, a client can get their refund within 4 to 7 days. It's really beating out these rapid refunds. Rapid refunds are when people want their refund right away. And you'll see these companies advertise, your refund in 24 hours, your refund today. They're very expensive. It's like 100% interest rate to get your refund. So if you're getting a $5,000 refund, they may charge you $400 or $500 to get that $5,000 today. Unfortunately, they hit a lot of more poor people who need money faster. I find it unethical to do rapid refunds. I did them for like 1 or 2 years. I refused to do them. I think it's taking advantage of people who need money. But if you do a direct deposit and to have your refund deposit directly in your bank account, you will get your refund relatively quickly. I've seen it as early as 3 days. Because we're electronically filing, the IRS has computers that look at the returns and refunds processed. And if you're electronically filing, and you do a direct deposit, it can be in your bank very quickly. So I'm hoping that rapid refunds go away, but there's a lot of companies out there who make money on rapid refunds. But that's my political. I'll get off my horse about that, but I just think it's just really it's a usury tax that you have to pay for that. So when you're done, you have to sign. You get the client to sign it, and you have to sign. And this is where you're going to put your firms. If you're not working for a firm, you put your own name. You have to have a PTIN. If you're paid preparer, if you get paid to do a tax return, you have to have what's called a PTIN. And we're going to talk about applying for those. But you're going to, if you're going to work for anyone, if you're going to do any kind of paid tax preparing, you need a PTIN. And when you prepare a return, you must sign it. If you prepare a return and you don't sign it, and that person gets audited and they find out it's heavy penalties. The IRS has done something in the last couple of years is it's easier to audit the tax preparer than the clients. So they'll come in and audit the tax preparer, and if they find out that you've been doing some sleazy stuff, they're going to audit all your clients. So you want to make sure and you have to every year take 2 hours of ethics. There's a lot of ethical things here, and we don't want to lie. And when you're signing a return, you're signing that you've checked this out. You verified that this taxpayer has 4 children. So we would have to verify when we're doing Myra's example of someone with 4 children, husband and wife. We would have to verify all those children, and usually that's done with Social Security cards. And then we would need some kind of letter that came to the house with the child's name on. It could be a school document, a church document, any kind of document, medical doctor's document that says this is the child's name and this is their address. Okay, so they filed legally for a minimum work year 2023 IRS approved, but never received any refund. Okay, so those are things, something like case like that, we would take a look at. And those are things that we can do. As you learn the basics, we have to look at that. And you can, if there's ever an issue with a tax return, and your refund's different, or the IRS usually 90% of the time is issuing a letter. If somebody moves, the letters get lost in the mail. So we always want to do that. I thought you had 4 children. So, but yeah, but I was using your example, 4 children. Your example had 4 children. So yeah, so we want to always, if there's ever an issue with a tax return, Myra's question, you can go to the IRS. Now you have to have permission. One, you would have to have signed that tax return to say, hey, yes, I am the preparer. The taxpayer has to give you permission to call on behalf of your client. Even if you did prepare the return, let's say in this example, someone filed a 2023 return, they never got the refund, and they come to me, and they're going to pay me. And this is where you make money off of tax season. Like we talked about in the beginning of other ways to make money, is someone's going to have an issue with a tax return, they come to me, they pay me, I'm going to research it. I can either bill them by the hour, or I can bill them and say, hey, it's going to cost you $550 for me to resolve this, to take a look at it. The taxpayer can call the IRS themselves. And a lot of times, they don't want to, because there's long holds, especially right now in the last year or so. The IRS has been cutting down in workers. So they're going to have a long hold when they call the IRS. But yeah, so you'd want to call the IRS and say, hey, where's my refund? It could, if they were receiving a refund check, it could have got lost. It could have got cashed. It could have something, could have happened to it. So that's what the stuff we want to do is, and that's what things we can do off of tax season to keep our income sources up. All of the tax returns I do in my office, I have audit protection. So that if there's ever an issue with and the audit protection also includes identity theft. When you prepare a tax return, and if there's an issue with it, the client always thinks it's your fault. It's never their fault. It's not the fact that they didn't give us that one document. So it's always, the tax preparer's fault. So I have audit protection, which is a company that just deals with any notices from the IRS or from Pennsylvania or from any state. So they cover. I pay for it for every return. I include it in my price. So that if a client does get audited, I can just hand it to them because I'm not going to get paid for it. So in following up on, I just spoke to a woman today who was audited for 2023. Now, I am still talking to her because she's my client, but I'm letting the company deal with the IRS because it's just letter after letter, and the IRS wasn't responding because they were on furlough. And, it's back and forth. And, I just reassure my client, hey, yeah, it's being handled. And, the big thing was how um, she bought health insurance on the marketplace. She was self-employed. Where do you deduct it? Um, and she reported one number, the documents reported another, so it was a kind of a misunderstanding, like what is the correct number. So that's what the IRS is saying. Because the IRS will come back if you receive a W-2 and you report a different number. The IRS will come back and correct it, say no, this is the correct number, because when you receive a W-2, and it's all electronic, so you can't lie. People used to be able to lie, but you can't lie because it's electronic. When your employer files your W-2 with the Internal Revenue Service, they already know you had a job. They already know you made money. They already know. So if you leave off, because I've had clients say, well, I don't want to report this W-2. The IRS already knows. So even if we file a return without that W-2, the IRS knows that. And if you do that, if the client tells you, hey, I don't want to file this return with this W-2, you can't sign that return because you know that they're lying. It's fraud. So, and that's part of, what you're agreeing to when you sign a return, that this return, to your knowledge, is not fraudulent. So let's go back to one of the handouts I gave you. Do you guys have any questions? All right, so here's the handout I gave you about the fundamentals of filing a return. So they have filing requirements. So you want to identify your taxpayer name, social security number, TIN. Usually you won't use an EIN number unless it's a business. But if they have a taxpayer identification number, if they don't have a social security number, what's their filing status? Do they need to file? If they received advance credits, they need to file. But if their income's low, and again, you would just go out on your Pub 17 and say, what's the 2025 filing requirement? So in 2025, the filing requirement of a single person is if they make $15,750. Married filing jointly is $31,005. It's the standard deduction. So I don't know if you can see that correlation, that the filing requirement is going to be the standard deduction unless they had self-employment income over $400. That's a really low threshold. So if someone is self-employed, they're a painter and they only make, $550, but they bought supplies of $600. Like, I don't have to file, I make no money. They do have to file. Or you have a dependent with unearned income. So unearned income is interest, dividends, unearned. Earned income is your W-2, your self-employment. You have a job, you go to work, earned income. Unearned is, you can sit back and the money just comes in. That's kind of how I think about unearned versus earned income. So you want to gather all the documents from your taxpayer. Did they receive any W-2s? Did they receive any dividends? These are all the forms. A mortgage or tuition paid is on a 1098. Brokerage and bank statements. Interest statements, if they received interest. If they were a contractor, they subcontracted, they would receive a 1099 NEC. If they had an investment in a partnership or an escrow, and you have a lot of people you don't realize are partnerships, is Partnership can be if you own stock in most of your gas companies, BP, Conoco, are all partnerships, and you might own, 0.000001 percent of it, and you will still receive a K1, and you have to report that 0.000001% on your tax return. Retirement distributions are reported on a 1099-R. So you're going to determine your adjustments. Did they give money to the IRA? Did they pay health insurance, student loans? Then you're going to standard deduction, itemize, and then credits. So this kind of just this paper, I kind of like it. Just kind of gives you an overview. You're going to calculate your tax and apply any payments. And then we're going to file and retain records. So we have here a the workbook. So each section you'll get this, and this is just basics, and we really want to things you can fill out yourself. What kind of learning goals did you meet or you want to achieve? But I always like to go. So I'm a practical kind of person more than some of the written. I like to fill out a return. So this is your homework for next week. Is I gave you a W-2. It's in the PowerPoint. So there's a W-2 from Paid to Work. Okay, so it was in your handout. So and it's a part of the PowerPoint slides. So the W-2 from the Paid to Work, you're going to take that, and then you're going to take, there's also a 1099 interest form from the bank at 125 Main Street with interest income. So you see those two things?
Yep.
Okay, you got them. All right, so I can share them here a little larger. So this is your interest statement. And then the W-2. The address was for the 123 Main Street for the Paid to Work and the bank statement. The bank was 125 Main Street, and the work employer address for the W-2. So it's on the W-2, and the address is on the W-2 and the 1099 INT. So this is our interest income. And the interest income is $326, and it should have been 26 cents, but there's an extra zero there. So that's your interest income. And then you have the W-2 income. And what you're going to do is prepare a return, just basic return. It's a single person. So you're going to use the standard deduction for a single person. And you're going to have to look it up for 2024 because I was giving you the 2025. So we're going to pretend we're doing a 2024 return. So the standard deduction for a single person in 2024 was 14,600. So you're gonna take the W-2 and you're gonna take the 1099 and you're gonna prepare the tax return.
Sounds good. And you said that's for like
Next,
what's on the
for
screen now.
Thursday, for Thursday.
Okay.
Yeah, for
And
Thursday.
then that's with 123 Main Street. And then remind me of the other form that you sent. You said it was the 1099.
Right. So you have yeah, the one that's up. So this is the one that up is the um W-2, and then let me show you. Then this is the 1099 interest.
Gotcha. Okay.
Yeah, yeah.
So use those two sheets for the return. Okay.
Right. And the guy's name, the taxpayers, I'm a taxpayer.
Yeah.
I'm a.
Yeah.
So that's their address, interest income. And then when we look at the W-2, taxpayers, same here. Social security numbers there,
Okay.
their wages, what taxes withheld.
Right.
We're gonna use the standard deduction from because we're doing a 2024 return.
Right. And you said that was 14,600.
Right.
Okay.
So you're gonna take this blank 1040 and you want to go up here and make sure, give you a little hint here, fill everything out. And this is a single person, so you've picked their filing status. They have no children. So if you look at the W-2, what are the wages and what line would that go on?
Is there any way you could zoom out on it a little more? I'm sorry.
On what, the
You
1040?
or I'm sorry, you're on the 1040. That doesn't even apply. I'm sorry. You said the W.
Right, but where does the W-2 wages go on a 1040? Because you're gonna fill out this form. This is the form you're gonna fill out for Thursday. This 1040, you're gonna fill it out and we're gonna see if they overpaid or do they get a refund. So you're filling out your first 1040. And down here is where the paid preparer is you're gonna sign your name here. Um, so that's your assignment, is to fill out this 1040. It's 2024 1040 for I'm a taxpayer.
Okay.
So you're gonna use the W-2 and you're gonna use the 1099.
Okay.
Yeah. All right.
Sounds good.
Okay. So one other thing I want to show you about the IRS is just share this part. So when you go on the IRS's website, so when we're on the IRS's website, here it is. Up at the top here, you'll see sign in Tax Pros. When you click on Tax Pros, you want to set up, if you want to prepare returns and get paid to do it, you're going to need to get the PTIN. And you need to do that before the end of the year for 2026 if you want to get paid. So you can renew a register. If you don't have a PTIN, you can go here, and all you need is your social security number or your taxpayer identification number. If you been convicted of a felony, you will not be able to prepare tax returns. So if you have a felony on your record, so that's the other thing I'd like you to do, and you have a week to do that, but I want you to start, get a PTIN. I think it's about $15 to $20. They charge $18 for renewal. So if you're serious, you don't have to do it right away, but as we go along in class, you're like, yeah, this is something I really want to do. Get your P10 before the end of the year. And this is where it's for the tax professionals. They talk about the old enrolled agents, the AFSP program participants. You can become an enrolled retirement plan agent, a CPOE, but that's for an employer organization. Um, e-file providers. E-file providers are only the business can become, like I personally cannot become an e-file provider unless I'm a sole proprietor. The bottom line is the e-file provider. But there's a lot of stuff here that you can learn about what it means to be a paid tax preparer. So the IRS is very helpful in like giving information out. And again, it's do you know where to find it? So, all right. If we don't have questions, we can end, but you know what your homework is for Thursday?
Sounds good.
All right.
Awesome. Thank you, Ollie.
Yeah, sounds good. So it's the same link every
Yep.
for this for the class.
Cool. Sounds good.
So okay, I'll see you guys Thursday.
Yep. See you
Uh,
Thursday.
all right. Take
All
care.
right. Have a good night.
Bye.
Yep. Bye-bye.